Welcome back to Accounting 101. As we get to the end of the semester, we've only got a couple more chapters left. Today we'll be talking about Chapter 11, Corporations, Organization, the Stock Transactions, and Stockholders' Equity. The learning objectives discuss the major characteristics of a corporation, explain how to account for the issuance of common, preferred, and treasury stock, explain how to account for the cash dividends, and stock splits, and discuss how stockholders' equity is reported and analyzed. So corporations. This is a separate entity, and it's separate and distinct from its owners. So we can classify them by purpose. It's not for profit or for profit. So here's some examples of both of those. And then classified by ownership, whether it's publicly held or privately held. Now we also refer to privately held corporations as closely held corporations. We'll go through some of the characteristics and talk about what they mean, that are the differences between corporations and either proprietorships or partnerships. So a corporation is a separate legal entity. That means it acts under its own name rather than the name of its stockholders. There's limited liability of stockholders. So the stockholders are limited only to their investment. So if you were to go out and buy stock in a company, whatever you spent on that stock is the most that you can lose. So that's your limit. If something were to happen and that company was sued or went bankrupt or something like that, you wouldn't have to, as a stockholder, wouldn't have to put in any more money to cover that. If it was a partnership or proprietorship, you might be liable for additional information to pay off debts and to pay off lawsuits and that type of thing. Transferable ownership rights. So shareholders may sell their stock. It's fairly easy to do with all the different stock exchanges that we have around the world. The ability to acquire capital. So a corporation can obtain capital through the issuance of stock. So they can get cash without having to take on debt. And it's a way that they can raise capital and raise cash for their business. Continuous life. Continuance as a going concern is not affected by the withdrawal, death, or incapacity of a stockholder, employee, or officer. Okay, so that just means that the company can continue. Partnerships and proprietorships typically end with the death or withdrawal of one of the partners of the proprietorship. There are some ways that they can continue that, but it's a little bit more complicated. In the general kind of feel is that, or the thinking is, if it's a partnership or proprietorship, that ends when one partner leaves or the proprietorship decides to cease. Corporate management. There's a separation of ownership, and management often reduces an owner's ability to actively manage the company. So although management can also be owners and own the stock, as a group, the stockholders don't have direct influence over the management of the corporation. Now they can influence it through voting on certain things, and we'll get into that a little bit, and how you make up the board of directors that give guidance and oversight to the CEO. But it's a little bit harder. It's not a direct one-to-one as in a partnership or proprietorship. The decisions I make every day are going to directly influence the company. So here, the ethics note: the managers who are not owners are often compensated based on the performance of the firm. They thus may be tempted to exaggerate the firm performance by inflating income figures. So we've seen that a little bit throughout the semester when we looked at some fraud where managers can manipulate the stock price and that type of thing because it benefits them. Government regulations. So although there's government regulations on all companies, no matter how they're incorporated or how they're structured, corporations have additional regulations. So listed on the stock exchange, you've got stock exchange requirements. There's SEC laws to go along with that, federal regulations, state laws that apply to corporations as well. So there's a lot more government regulations. And then finally, there's additional taxes. So corporations pay income taxes as a separate legal entity. So they don't, the owners aren't taxed directly on the earnings of the corporation. They file those taxes separately. But when they pay out dividends, cash dividends to stockholders, the stockholders have to pay taxes on that as well. So that's the double taxation. Here's a pretty basic organizational chart, pretty standard if you think about how corporations are organized. So the shareholders are on top. They give input to the board of directors, who then manages the CEO. And then the CEO has their team reporting to him or her. And then here in the finance accounting area, Vice President of Finance or the Chief Financial Officer is the head financial person. Typically, they have the treasurer and the controller under them as well. A couple variations I've seen sometimes. Information technology or IT comes under finance. Sometimes there's procurement that comes under finance. Other times procurement is separate from finance. So there can be differences to this, but this is kind of the basics. If you think about this, you're going to probably hit 90% of the corporations in their basic structure. So we talked about the characteristics. Now, which of those are advantages and which are disadvantages? So, separate legal existence, the limited liability of stockholders, transferable ownership rights, the ability to acquire capital, continuous life, all strong advantages of being a corporation over a partnership or proprietorship. Disadvantages, the additional government regulations and the additional taxes. Now, corporation management shows up in both the advantages and disadvantages. Okay, the advantage, remember this is where the owners are separate from the management of the corporation. The advantages is you get professional managers, so people that's their job. They've gone to school for that. They've have experience in potentially other companies, and they can bring that to the corporation versus just a random owner and what they just relying on their own experiences. But it's also a disadvantage because it separates ownership and management. So the management team, you hear the phrase a lot in business, think like an owner. Think about if it's your own money. And we say that because it's not. It's not your own money. It's not your own company. You're not an owner. So there's that difference, and that's a disadvantage for the most case because they're thinking more of what's going to benefit them versus always what's best for the company. Forming a corporation. So you have to file an application with the Secretary of State in whichever state you want to incorporate in. The state grants a charter. The corporation develops bylaws. And then the companies generally incorporate in a state where laws are favorable to the corporate form of business organization. More than 50% of the 500 largest U.S. corporations are incorporated in Delaware. So Delaware historically has been a state that's been very favorable to corporations. It's easy to do business. It's a very small state. Then there's not a lot of industry in that state, even though over 50% of the 500 largest U.S. companies are there. Basically, what it is they've got some attorneys that sit in offices, and they're the um, uh, spokesperson's not the right, they're the representative of the company. So official communication um, goes through them. So they just have to have that kind of representative in the state. So they pay attorneys to be that, so they could be the representative for multiple corporations. Um, Now, lately, probably the last um, 5 to 10 years, it's becoming less favorable, and you're seeing some companies move out of Delaware. Um, One of the reasons is they're Delaware, like most states, are trying to increase their tax revenue. So one way to do that is go after the corporations in their state, um, and they've been having an increase in some of the audits they do and some of the money they're trying to claw back from companies that have always been available to them that just haven't exercised it. So with that, corporations are looking for some different states that may be more beneficial to them. If a corporation is engaged in interstate commerce, so it's between the states, they must obtain a license from each state in which they do business. So they incorporate in one state. So if they do Delaware and then they're going to have a business, presence in Illinois, they then have to file with the Secretary of State of Illinois and get a license from them to be able to operate within the state. So the charter that the state grants is often referred to as Articles of Incorporation. So if you hear that term in charter, it's used interchangeably as companies corporations are formed. Stockholders' rights. So the stockholders, we talked about it a little bit, that they can influence the company even though they don't have direct management. They vote in election of board of directors at the annual meeting, and they vote on actions that require stockholder approval. So a common one that you see almost every year if you own stock in a corporation is, you know, who the auditor should be. And basically is a certain firm as our auditors, do you vote to retain that auditor? So that always goes to a vote of the stockholders. And then a lot of times companies will send out proxy statements, which says, kind of outlines what's can be voted on, tells the shareholder how they can vote, or they can simply give their vote to the board of directors and allow the board of directors to vote on their behalf. So that's a common thing that some stockholders do, is they just go ahead with whatever the board of directors are recommending and then give them their vote so they can vote that way. And then stockholders share in the corporate earnings through the receipt of dividends. So as the company is successful and they have cash, they can pay out dividends, and that's a way that the shareholders can get some return on their investment into that corporation. Preemptive right, so it's the right to keep the same percentage of ownership when new shares are issued. So if I own 14% of a company and there's preemptive rights and new shares are issued, I have the chance to keep my ownership the same percentage and then buy those additional shares without it going into the open market. Now, a number of companies have eliminated this right, so they can issue their new shares without having to keep the same, or give the opportunity to keep the same percentage ownership to the existing shareholders. And finally, the residual claim on assets. So if a company is liquidated, goes out of business, the stockholders get the residual claim. So they are going to pay off all their creditors, and any assets that are left will go to the stockholders. When a corporation decides to issue stock, it must resolve a number of basic questions. So how many shares should it authorize for sale? How should it issue the stock, and what value should the corporation assign to the stock? So the charter or the articles of incorporation indicates the maximum number of shares that a corporation is authorized to sell. The number of authorized shares is often reported in the stockholders' equity section of the balance sheet. There's no formal accounting entry on the authorization, except the only thing that it may be on the balance sheet as a note. It doesn't mean that's what they're required to sell or have to sell. So there could be a difference between authorized and outstanding. Companies issue common stock directly to investors or indirectly through an investment banking firm. So if you hear of company going public for the first time, it's called an IPO, an initial public offering. Typically, it used to only you'd have to go through banks to do that. So the bank would buy the initial shares and then immediately turn around and sell it to the public. So the company gets their share. They're pretty much guaranteed because it's going through investment banking. Now it's more common that you see corporations doing a direct to the public initial public offering. It's easier to do with some of the trading platforms that are out there, so they don't have to pay those fees to the investment bankers and that type of thing. And then there's a number of factors in setting the price of a new issue of stock. Companies' anticipated future earnings, so looking at what they think their future earnings and their forecasts are for future years. It's expected dividend rate per share, so what they think they're going to pay out in dividends. The current financial position of the corporation. The current state of the economy. Are we in inflations? And you'll see IPOs kind of go in waves, where if the economy is going strong, you might see a lot of IPOs because companies think they can be able to sell their stock at their expected price, and it can be a higher price than if it's in a down economy. If the economy is weakening, you'll see some IPOs potentially canceled or less activity. So looking at that will determine how they issue it. And then finally, the current state of the securities market. So if the securities market is weak, they're probably not going to be able to set as high a price as if the securities market was going strong. And again, they may try to time it a little bit, and if they can wait out a week period and before they do their IPO, they may do that. So there's a lot of things that go into setting the price when they issue stock. So here's another fraud example. The president and chief operating officer and the chief financial officer of SafeNet were awarded employees stock options by the company's board of directors as part of their compensation package. And that is a typical way to compensate high-level executives. So stock options they enable the employee to buy a company stock sometime in the future at the price that existed when the stock option was awarded. Okay, so for example, suppose you received stock options today when the stock price of your company was $30. 3 years later, if the stock price rose to 100, you could exercise your options, which means that you buy the stock for $30 per share. You immediately make $70 per share. You can either hold that stock and then or immediately sell it. So you can do, there's ways you can do that without having to put up the cash to buy those shares. You can do a non-cash exercise where you tell the company that holds your options that you want to exercise it and immediately sell it. So then you don't have to put up the $30 per share in the first place. That they just are going to sell those shares at whatever the market price is, and then you don't get that full amount, you get that minus the $30. So there's ways you can do it without having to put up the cash up front. So anyway, in this case, after being awarded their stock options, the three employees changed the award dates in the company's records to dates in the past when the company's stock was trading at historical lows. For instance, they would choose a past date when the stock was selling at $10 rather than $30. So then when they exercised it, they only had to pay the $10. If it's still selling at 100, they would make $90 per share instead of the $70 per share. So they were able to get $1.7 million additional money because of doing this. So the company's board of directors should have ensured that the awards were properly administered. The date on the minutes from the board meeting should be compared to the dates that were recorded for the awards. In addition, the dates should again be confirmed upon exercise. So no one was checking that, and they were able to change that. Par and no par value stock. Years ago, par value determined the legal capital per share that the company must retain in the business for the protection of the corporate creditors. So it said that you had to put a par value and you had to maintain that capital at a minimum, and that was to protect the creditors, that there would be some money in the corporation to pay them. Today, many states don't require this, and no par value stock is fairly common. In many states, the board of directors assigns a stated value to no par shares, which acts in the same way from an accounting perspective as a par value. So even though no par value is more common, we'll go through examples assuming that there's par value and how do you account for the common stock transactions with the par value. So which of these statements is false? The ownership of common stock gives the owner a voting right. The stockholders' equity section begins with paid-in capital. The authorization of capital stock does not result in a formal accounting entry. And legal capital is intended to protect stockholders. The answer is D. Legal capital is intended to protect stockholders. That is false. What it's there for is to protect creditors, not the stockholders. Indicate whether the following statements is true or false. Similar to partners in a partnership, stockholders of a corporation have unlimited liability. That is false. It is relatively easy for a corporation to obtain capital through the issuance of stock. That is true. That's one of the advantages of a corporation. Separation of ownership and management is an advantage of the corporate form of business. Okay. The answer is false, but as we talked about, there are some advantages of having that separation because of getting managers that have gone to school for that and have different backgrounds. So it's kind of a tricky one for both of the most case. It is a disadvantage. The journal entry to record the authorization of capital stock includes a credit to the appropriate capital stock account. That is false. We'll get into the journal entries in a minute. We'll see those examples. And all states require a par value per share for capital stock. Again, that is false. Now we'll look at the ones that are false and what makes them true. So the liability of stockholders is normally limited to their investment in the corporation, not unlimited liability. The separation of ownership and management is a disadvantage. We spoke about that already. The authorization of capital stock does not result in a formal accounting entry. And then many states do not require a par value. So paid-in capital is the total amount of cash and assets paid into the corporation by stockholders in exchange for capital stock. When a corporation has only one class of stock, it is common stock. And that's what we've seen most of the time in this class as we've done stockholders' equity transactions. Retained earnings is net income that a corporation retains for future use. Net income is recorded in retained earnings by closing entry that debits income summary and credits retained earnings. So remember those closing entries that we did. If Delta Robotics has a balance of $800,000 in common stock, $130,000 of net income at the end of its first year, stockholders' equity section would look like this. So before we just had common stock and retained earnings, now we're going to break it out and say paid in capital, and it's going to be common stock. And we'll look at some different things that go in paid in capital as we go through this chapter. So if we compare a corporation versus a proprietorship, in a corporation, we're going to have a common stock account, we're going to have retained earnings. As a proprietorship, we just have one account called owner's capital. So net income and everything goes into that as well. At the end of the first year of corporation, Dorel Corporation, or first year of operation, sorry, Dorel Corporation has $750,000 of common stock, net income of $122,000. Prepare the closing entry for net income in the stockholders' equity section at year end. So remember, if you do the closing entries and our net income is 122, we close revenue and expenses into income summary. The balance is going to equal our net income. Going to have a credit balance, so we're going to debit income summary, credit retained earnings. And then in the stockholders' equity section on the balance sheet, we'll have paid in capital common stock for the $750,000. Our retained earnings is $122,000, and our total stockholders' equity $872,000. Now we'll get into how do we account for the issuance of common, preferred, and treasury stock. So we'll start with common stock. So we're going to identify the sources of paid in capital, maintain the distinction between paid in capital and retained earnings, and the issuance of common stock affects only paid in capital accounts. So HydroSlide issues 1,000 shares of $1 par value common stock. Prepare their journal entry if 1,000 shares are issued for $1 per share. And then separately, what does the entry look like if we had 1,000 shares issued for $5 per share? In the first case, if we issue it for the same as our par value or stated value, it's a simple debit cash, credit common stock entry that we've seen before. So it's just like we've seen before. So it's 1,000 at $1 is the par value, and then we issued it for the same, so that's the cash we receive. In the second example, if we issue it for 1,000 shares for $5, we're going to receive $5,000. Now we're going to break that out between what the par value is. So the 1,000 at $1 par value, common stock still gets credited for the $1,000. The difference, the $4,000, gets credited to this new account called paid in capital in excess of par common stock. Okay, so it's a paid in capital in excess. And if we look at how that looks on the balance sheet, we add that here into the paid in capital section. So now we have a subtotal with paid in capital, and then our retained earnings to get our total stockholders' equity. So assume that instead of $1 par value stock, HydroSlide has $5 stated value, no par stock, and the company issues 5,000 shares at $8 per share for cash. Entry is very similar, and I'll point out the differences. So we're going to debit cash at our 5,000 shares issued at $8, so the 40,000. Our common stock is going to be 25,000. We get that by the value, the stated value, the $5 per share times the 5,000 shares is 25,000. Just like we would have if it was par value. We took the number of shares times the par value. We take the number of shares times the stated value. The difference then goes into the paid in capital in excess. In this case, it's excess of stated value instead of par value. So you're just basically changing the words from par value to stated value, and it's the same type of transactions. If they do not assign a stated value to its no par stock, how does it record the issuance of 5,000 shares at $8? We simply put it all into common stock. So debit, cash, 40,000, credit, common stock, 40,000. We don't have to worry about the what's par or stated value into common stock and then the difference into the in excess, paid in capital in excess, because there is no excess, because there's no stated value and there's no par value. So issuing common stock for services or non-cash assets. So corporations may also issue stock for services. They do this a lot on startup. So some of their attorneys or consultants to help them start up the business, they may pay them in common stock versus cash. And they can acquire assets, non-cash assets, so land, buildings, equipment, especially if a company is starting up, they may not have cash available to buy some things that they need for their business, so they can issue common stock for that. So how do we account for that? So attorneys have helped Jordan Company incorporate. They have billed the company $5,000 for their services. They agree to accept 4,000 shares of $1 par value common stock in payment of their bill. At the time of the exchange, there is no established market price for the stock. Okay, prepare the journal entry for this transaction. Since we don't have a established market price, we can't state what the shares are worth. So what we have to look at is any other evidence to value this transaction. In this case, we have an invoice. It's for $5,000. So we're going to debit organization expense for $5,000. The common stock, we issued 4,000 shares. It's $1 par value, so we take 4,000 times 1, and we credit common stock for that. The difference goes into paid in capital in excess of par. Okay, just like we would have if we would have received $5,000 of cash, but in this case, we're recording the expense, and we issued the common stock instead of paying cash to pay this bill. Now for a non-cash asset. Athletic Research is an existing publicly held corporation. $5 par value stock is actively traded at $8 per share. The company issues 10,000 shares of stock to acquire land, recently advertised for sale at $90,000. Prepare the journal entry for this transaction. So now we look at this and say, okay, land was, they were asking $90,000 for land, and we know that the stock is trading at $8 per share. We're going to issue $10,000. So what do? We're going to debit land for $80,000. That's the market price of the stock, $8 per share times the 10,000 shares. Common stock is 10,000 times the par value, so the number of shares times the par value, 50,000. The difference, 30,000 in this case, goes to paid in capital in excess of par for common stock. Now, just because land or real estate is offered at a sale price, there's typically a negotiation that happens, so you don't always pay that advertised price. So you don't have that. That's not the same as an invoice. It's just kind of the starting point for negotiations. In this case, since they're accepting 10,000 shares and it's trading at $8 a share, the value we put on that asset is the $80,000. Accounting for preferred stock. So everything we've talked about so far is on common stock. There's also a class of stock called preferred stock. What that means is the preferred stockholders have priority to distribution of earnings, the dividends, and they have typically priority to the assets in event of liquidation. We account for preferred stock at issuance, very similar to that of common stock. So Stein Corporation issues 10,000 shares of $10 par value preferred stock for $12 cash per share. Entry, again, very similar to the common stock. We're going to debit cash for the $120,000. That's what the price per share of $12 times the number of shares, 10,000. Now instead of common stock though, we're going to use the preferred stock account. Same thing with the par value at $10 at the 10,000 shares. So we credit preferred stock for 100,000. The difference again goes in paid in capital in excess of par, but in this case it's excess of par for preferred stock, and that's the 20,000. So very similar. We're just changing out the words common to preferred, and it's basically the same entry. How to read stock quotes. So we talked about change of ownerships because stockholders can sell their shares of stock in a corporation fairly easily. They do this in unorganized exchanges. In the U.S., it's the U.S. Stock Exchange, and the NASDAQ is another stock exchange. It's more technology companies for the most part. So two different ones in the U.S. that are kind of used interchangeably when you think about trading U.S. stocks. There's the FTSE in London. There's German accounts. There's the Nikkei in Japan. So around the world, there's different stocks, and different companies can choose to be listed in different on different exchanges. Typically, it's closest to where they are. So most U.S. companies are listed on U.S. exchanges. European companies are listed on the European exchanges as well. The Japanese companies again on the Nikkei. So if you wanted to buy some stock in those companies, you would have to go to those exchanges and make the purchase. But it's fairly easy to do nowadays. So these exchanges trade the stock of publicly held companies at dollar prices per share, established by the interaction between buyers and sellers. So for each listed security, the financial press reports the high and low prices of the stock during the year, total volume of the stock traded on a given day, the high and low value prices for the day, the closing market price with the net change for the day. So this is Meta, listed on the NASDAQ. Here's a recent listing. So we've got the stock symbol. So when you get listed on an exchange, you come up with a symbol for your company. Some famous ones: AT&T is T, Ford is F, but typically it's a 3 to 4 letter thing that might indicate the company and that type of thing. So we list the highs and lows for the year. So for the last 52 weeks, it's traded between 54.66 and 86.07. The volume for the day, so 54 million shares traded hands on the exchange on this day. The high and low for the day, so it traded within this range for the day. And the close is what it was at the close of the market. And then the change from the day before. Now with the technology and the different apps, there's a lot more after close trading that can still happen. So there's certain shares you can buy and sell 24 hours a day. You don't have to do it when the market's open because it can be done electronically. Before, if you had to buy and sell stock, you'd have to put in an order with a broker. They would have someone physically on the floor of the exchange making that trade, finding a seller for what you wanted to buy, or if you were selling, a buyer for wanting to pay that price of what you're selling. So it was very interactive and manual. With the technology nowadays, it can happen almost any time, and it does happen 24 hours a day for some stock. So for stocks traded on organized exchanges, how are the dollar prices per share established and what factors might influence the price of shares in the marketplace? So again, the dollar prices per share are established by the interaction between buyers and sellers of the shares. The factors that might influence the stock price include company's anticipated future earnings, its current financial position, current state of the economy. Again, all factors that we talked about earlier when a company is setting the initial um, selling price of their stock. So it's the same types of things. Investors are looking at that, looking at the information that's available. Did they just have any news about the company that may influence that stock directly, or just general economy? Um, if uh, the labor statistics come out each month, that's going to impact the stock exchange. When they release inflation figures, that's going to affect the exchanges and what happens to the prices. So all of that goes into um, what the market price of the stock is. So Cayman Corporation begins operations on March 1st by issuing 100,000 shares of $1 par value common stock for cash at $12 per share. On March 15th, it issues 5,000 shares of common stock to attorneys in settlement of their bill of $50,000 for organization costs. On March 8th, Cayman Corporation issues 1,500 shares of $10 par value preferred stock for cash at $30 per share. We're going to journalize the issuance of the common preferred shares, assuming the shares are not publicly traded. Okay, so when they issue the initial 100,000 shares, $1 par value common stock for $12 per share, the entry is debit cash 1,200,000, credit common stock, it's the 100,000 shares at the par value of $1, $100,000 credit, and then we're going to credit paid in capital in excess of par for common stock for the 1,100,000. Next, on the payment of their attorney's bill, they had a bill for $50,000. Since we're not publicly traded yet, we don't have a market value, so we're going to debit organizational expense for $50,000. We gave them 5,000 shares, so we're going to credit common stock for 5,000 shares at $1 par value, the $5,000. The difference gets credited to paid in capital in excess of par for common stock. And finally, when we issue the preferred stock, 1,500 shares at $30 per share. So we have $45,000 cash that we receive, so we debit cash for that $45,000. Preferred stock is our 1,500 shares at our par value of $10, so $15,000, and then we credit paid in capital for the difference. So paid in capital in excess of par value preferred stock gets credited for $30,000. Next, we'll talk about treasury stock. So treasury stock is a corporation's own stock that it has reacquired and is being held for future use. So this is a company going out to an exchange where their stock is traded and in the open market buying their shares back. So there's some reasons they do this. It's to reissue the shares to officers and employees under bonus and stock compensation plans. So if they're issuing stock as part of compensation or bonuses, they need those shares to be able to issue those. So one way of getting those is to buy it back on the open market and then issue them as part of those plans. To enhance the stock's market value, so the fewer shares out there typically raises the market price of the stock. In addition, to have additional shares available for use in acquiring other companies. So a common way of acquiring companies and growing is to issue your stock instead of issuing cash, and then to increase earnings per share because treasury stock is not considered outstanding. So when you use outstanding shares to calculate earnings per share, by decreasing that, You're without increasing earnings, you're automatically going to increase your earnings per share. Companies generally use the cost method when accounting for treasury stock. They debit treasury stock for the price paid to reacquire the shares. Treasury stock decreases by the same amount when the company later sells the shares. And treasury stock is a contra stockholders' equity account. It reduces stockholders' equity. So stockholders' equity accounts, common stock, paid in capital in excess of par, for example, retained earnings, normally has a credit balance, increases with the credit. As a contra account, treasury stock has a normal debit balance and will increase with the debit. So here's an example. We have Mead Incorporated. Their balance sheet looks like this. They have common stock, $5 par value, 400,000 shares authorized, 100,000 shares issued and outstanding. So that's got a credit in common stock of $500,000. The 100,000 shares issued and outstanding at $5 par value. Their retained earnings at this point is $200,000, so total stockholders' equity is $700,000. Then on February 1st, they're going to acquire 4,000 shares of its common stock at $8 per share. So when we look at the balance sheet after they acquire that, the number of shares issued, 100,000, and the number of shares held in treasury are disclosed. So before we had $5 par value, 400,000 shares authorized, 100,000 shares issued and outstanding. Now we have 100,000 shares issued, but only 96,000 are outstanding. So we show that distinction. And now we have treasury stock down below, 4,000 shares, $32,000, and that reduces our stockholders' equity. So our stockholders' equity reduced by $32,000 from $700,000 to $668,000. When we dispose of treasury stock, it's typically sold. The accounting for it, sale differs when it's sold above cost or below cost. So depending on if we sell it for more or less than what we acquired it for. Treasury stock transactions are classified as capital stock transactions. As in the case when stock is issued, the income statement is not involved. So if we sell it at a different price than what we acquired it for, we don't have a gain or loss that goes to the income statement. We just account for it in the capital stock transactions and in that section of the balance sheet. So if we sell $10 per share, 1,000 shares of its treasury stock previously acquired for $8 per share. Okay, so we bought it for $8. We're selling it for $10. We're not selling everything we acquired. We're just selling 1,000 shares. So we're going to debit cash $10,000. So it's the 1,000 shares at $10 per share. We're going to credit treasury stock. Again, we're going to reduce treasury stock with the credit 1,000 shares at $8 because that was our cost. So treasury stock account is always at our cost when we sell it again. And then we have a new account, paid in capital from treasury stock. We're going to credit for $2,000. So that's that additional that we're receiving versus what we paid for the treasury stock. It goes into that paid in capital. We don't realize a gain or suffer a loss through the income statement through these stock transactions. Now we're going to sell an additional 800 shares at $7 per share. So that's less than our cost. So we're going to debit cash $800 times the $7, 5,600. Our treasury stock credit, we're going to reduce our treasury stock with the credit at the 800 shares times $8, which is our cost, so 6,400. To make the entry balance, we need a debit of $800, and we're going to debit that paid in capital from treasury stock. Okay, what does that look like when we post these entries? So our treasury stock increased $32,000. That was the initial purchase. We had 2 sales, so we credited that account at the same per um, uh, share price that we paid for it, the cost. So we have a balance of 17,600 now in treasury stock. Our paid in capital in treasury stock, July 1st, we sold it for more than what we paid for it, so we had a credit in this account. The second sale, it was less than what we paid, so we reduced that amount by that difference, that $800, so we have a balance of 1,200 in that paid in capital from treasury stock. Now this paid in capital from treasury stock is a unique account. So we've seen how we credit it. If we sell treasury stock for more than we paid for it, it decreases in debits. If we sell treasury stock for less than what we purchased the treasury stock for. But the paid in capital from treasury stock can only have a credit balance or a zero balance. We cannot have a debit balance in this account. Okay, so let's look at what happens. When it fully depletes the credit balance and paid in capital, so it takes it to zero, we then use retained earnings to debit any excess cost over selling price. Okay, so we're gonna directly decrease our retained earnings. So we sell the remaining 2,200 shares at $7 per share. We have cash, same that we've seen before, number of shares at the price per share we sold it for, so 2,200 times 7, 15,400. Our treasury stock gets credited at cost, so 2,200 shares at $8 cost, 17,600. We have $2,200 that we need to debit, and what we do is we debit paid in capital from treasury stock for 1,200 because that's the balance that's in that account. So if we flip back here, that's the remaining balance. So that's all that we can use there. The difference goes into retained earnings for the $1,000. We debit that directly. Okay. If we don't have anything in our paid in capital, so we have a zero balance already in that account, then everything would go right to retained earnings. So if it's the first time we sell treasury stock and we sell it for less than we bought it for, we're going to immediately debit our retained earnings. So you can debit that paid in capital as long as there is a credit balance there. If there's not, then you debit retained earnings. Now we'll look at Reebok. They at one time bought back nearly a third of its shares. Repurchase of shares dramatically reduced Reebok's available cash. In fact, the company borrowed significant funds to accomplish this repurchase. In a press release, management stated that it was repurchasing the shares because it believed its stock was severely underpriced. The repurchase of so many shares was meant to signal management's belief in good future earnings. Skeptics, however, suggested that Reebok's management was repurchasing the shares to make it less likely that another company would acquire Reebok, in which case Reebok's top manager would likely lose their jobs. So they depleted their cash, they took on debt, they became less attractive acquisition target, fewer shares outstanding, so it's harder to buy up shares to get a controlling interest. Acquiring companies typically target companies that have large cash balances, potentially lower debt, so they can pay off the debt they go into to make the acquisition. So what signal might a large stock repurchase send to investors? Might signal that management believes stock is underpriced, which would hopefully result in increased trading of the company stock in the securities market. However, the purchase of treasury stock reduces the cushion for creditors. To protect creditors, many states require that a portion of retained earnings equal to the cost of treasury stock purchase be restricted from being paid as dividends. So we'll look at more examples of accounting for treasury stock. Santa Ana purchased 3,000 shares, $50 par value, common stock for $180,000 cash on July 1st. It will hold the shares in treasury until resold. On November 1st, the corporation sells 1,000 shares of treasury stock for cash at $70 per share. Journalize the treasury stock transactions. So the initial purchase, we're going to debit treasury stock for the $180,000 and credit cash. When we sell a third of that, 1,000 shares, so we're going to debit cash for 1,000 times $70. So that's the price we sold it at. We're going to credit treasury stock for the cost. Now it doesn't give us in this example what the cost per share was when we bought it, so we have to calculate that. So $180,000, 3,000 shares. Take 180,000 divided by 3,000, we get $60 per share. So when we sell 1,000 shares, it's $60,000. The other way we could look at that is we sold 1,000 shares, which is a third of the 3,000 shares we bought. So we could take a third of the 180, that's the 60,000. So two ways you can look at that, but you have to look at, kind of figure out what the cost was. The par value on the common stock is doesn't matter when we're looking at the treasury stock here. So make sure if you see that, that's not the price that we paid for it. That's the par value, and we ignore that in this case. Since we sold it for more than we bought it for, we need $10,000 credit to make the entry balance. That goes into our paid-in capital from treasury stock. Now let's look at dividends. So cash dividends, stock dividends, and then we'll talk about stock splits. A dividend is a distribution of cash or stock to stockholders on a pro rata, which means proportional to ownership basis. We can have cash dividends, we can have property dividends, we can have stock dividends, and scrip promissory note. Dividends are generally reported on a reported quarterly as a dollar amount per share. So we're going to focus on cash dividends and stock dividends in this chapter. So a corporation, to pay a cash dividend, must have three items. Must have retained earnings. So payment of cash dividends from retained earnings is legal in all states, but you have to have that to be able to pay it. If you had a net loss and a deficit in your retained earnings account, you cannot pay a dividend. Must have adequate cash, so it must have the cash to pay the cash dividend. And the dividends have to be declared by the board of directors. There's three key dates to keep in mind around dividends. The first is the declaration date. That's when the board authorizes that a dividend is going to be paid. The record date or date of record, that's where the company figures out who owns the stock on that date, because those are the individuals that are going to be receiving the dividends. And the payment date, sometime in the future, that's when the company actually pays the dividend. Okay, so there's typically a time period between each of these. In this case, we have a couple weeks from the declaration date to the record date, and then we have 3 weeks, is that right? Yeah, until the payment date. So as the shares trade hands between the declaration date and the record date, most likely the stock price is going to reflect that there's a dividend. So if I sell my stock after the declaration date but before the date of the record, I'm not going to get the dividend. Whoever buys it from me, if they're holding it on the record date, they're going to get the dividend. So I'm going to probably demand that I get at least a portion of that. So I'm going to demand a higher price if I try to sell my stock. So the person that's buying it has to recognize that and be willing to pay for that, because they're going to receive that cash. So we don't get into the theories of how that works. Another finance class can kind of get into how that how that works and what the theories are behind the different stock prices, but just be aware of that. I like to throw that in there as well. So on December 1st, the directors of Media General declare a 50 cents per share cash dividend on 100,000 shares of $10 par value common stock. Dividend is payable on January 20th to shareholders of record on December 21st. So what entries do we make on these different dates? On the declaration date, we're going to record that we're going to pay a cash dividend. So we're going to debit cash dividends. And then since we're not paying it yet, we're going to set up a liability, our dividends payable, for the 50,000. 100,000 shares, 50 cents per share. That's how we got the $50,000. On the date of record, December 22nd, there is no accounting entry. So there's no accounting transaction that takes place. The company will have to identify who the stockholders are at that date so they can pay the dividends to that stockholders, but there's no accounting entry. And then finally, when we pay the dividends on January 20th, we debit our dividends payable, that liability we set up already, and credit cash. So those are the entries we make on the declaration date and the payment date. When using a cash dividends account, Media General should transfer the balance of that account to retained earnings at the end of the year by a closing entry. So before, we've seen when we closed dividends to retained earnings, when we did the closing entries, we just called the account dividends. Cash dividends is a dividend account, acts the same way. So at the end of the year, we're going to close the cash dividends account into retained earnings by debiting the cash dividends account, crediting cash dividends, debiting retained earnings. Okay, because remember, dividends is part of debt, debits are expenses, assets, and dividends. Cash dividends is a dividend account, so it's got a normal debit balance. When we declared the cash dividend, we debited that account. Then when we close it, because it's a temporary account, close it into retained earnings with the credit to cash dividends, debit to retained earnings. So if you have some excess dollars you want to invest, you might consider stocks that pay dividends. According to data from Standard & Poor's Dow Jones Indices, dividend income made up 33% of the monthly return of the S&P 500 between 1926 and 2015. What that means is that dividends comprise 1/3 of the return to shareholders. In addition, data from 1927 to 2014 indicate that dividend payers outperform non-dividend payers, averaging 10.4% annual growth versus 8.5%. So here's a table that if you invested $10,000 at those growth rates, what your investment would be worth. So in 10 years, it's a little bit more. 20 years, the difference is growing, and in 30 years, it's almost double, $700,000. So it's 1.3 million to 2 million. So that growth compounds over years. So that could be, a big difference if you hold on to it for a long time. The dividend yield ratio, is the annual dividend per share divided by the market price per share. Some companies have strong dividend yields, such as Coca-Cola and AT&T. Others have been increasing dividend payouts at a strong clip, Microsoft, McDonald's, Intel. So what factors must management consider in deciding how large a dividend to pay? So if they historically pay dividends, stockholders are going to expect to receive that and therefore monitor dividend practices. The payment of a large cash dividend could lead to liquidity problems for company. So if you're continually paying a large amount of cash dividends and you run into cash flow problems, you may have to borrow or you may not be able to pay as much. A smaller missed dividend might cause dissatisfaction among stockholders. So some investors look for companies that pay dividends. So Coca-Cola and AT&T were examples here that consistently pay strong dividends. So they may invest in those companies just for that. It's at least one thing to think about as you're investing in companies. So if a company changes their dividend policy, um, they may lose some investors because of that. Dividend preferences for preferred stock. So when we introduced preferred stock, we said they have a um, uh, priority to dividends. So they get the right to receive dividends before common stockholders. It does not guarantee the payment of dividends. It only says that if dividends are paid, the preferred stockholders get it first. Per share dividend amount is stated as a percentage of the preferred stock's par value or as specified amount. So we know we can calculate what preferred stockholders are going to get when dividends are paid. And most preferred stocks also have a preference on corporate assets if the corporation fails. So there's certain assets that are tagged to preferred stockholders. When preferred stock is cumulative, preferred stockholders must be paid both current year dividends and any unpaid prior year dividends, which is referred to as dividends in arrears, before common stockholders receive dividends. Dividends in arrears is not considered a liability because, again, it's not a guarantee that dividends are going to get paid. It's just that when they pay them, they pay preferred stockholders first, and if it's cumulative, they pay the prior years first. No payment obligation exists until the board of directors formally declares that a corporation will pay a dividend. So we'll look at some examples of that. So Scientific Leasing has 5,000 shares, 7%, $100 par value, cumulative preferred stock outstanding. So that 7% means that each $100 share pays a $7 dividend, 7%, the percentage times the par value. The annual dividend is $35,000. So the 5,000 shares at $7 per share. So anytime a dividend is paid, $35,000 first go to preferred shareholders. If dividends are 2 years in arrears, preferred stockholders are entitled to receive the following dividends in the current year. So they're going to get the dividends in arrears, the dividends that didn't get paid the prior 2 years. So $35,000 a year times 2 years, $70,000. Current year dividends, they get paid first, so $35,000. So preferred stockholders are going to get $105,000 of the dividends before any of the common stockholders get dividends. So IBR has 1,000 shares, 8%, $100 par value, cumulative preferred stock outstanding. It also has 50,000 shares of $10 par value common stock outstanding. At December 31st, 2027, they declare a $6,000 cash dividend. Prepare the entry to record the declaration of the dividend. Okay, so we're simply going to debit cash dividends $6,000, credit dividends payable $6,000. Okay, so we don't differentiate between common or preferred stock and what their dividends are. When we declare it, we just put it all in cash dividends and set up the dividends payable. Now, if we look at the preferred dividends, we had 1,000 shares, 8%, $100 par value, $8,000 of preferred dividends. We only declared and we're only paying $6,000. So dividends of $2 per share, the $8 that's stated and the $6 that are being paid are in arrears on preferred stock at 2020 for 2027. They must pay this $2,000 in dividends in before they can pay future dividends to common stockholders. So in 2028, if they declare a dividend, first $2,000 is going to be paid to preferred dividends for the the arrears, and then that year's preferred dividends of $8,000 before we can pay the stockholders. So on December 31st, 2028, they declare a $50,000 cash dividend. So how does that get allocated? The 2,000 dividends in arrears to preferred stockholders are first, then the 2028 dividend of $8,000 to preferred stockholders. So $10,000 goes to preferred stockholders. The remaining $40,000 gets paid to the common stockholders. So again, pay what's in arrears to preferred stockholders if it's cumulative. If it wasn't cumulative, you would ignore that $2,000 that didn't get paid, and you would just pay the $8,000 for the current year. So when they declared the $50,000 cash dividend, what entry do we make? Debit cash dividends 50,000, credit dividends payable 50,000. So Mastermind Corporation has 2,000 shares, 6%, $100 par value preferred stock outstanding at December 31st, 2027. At December 31st, 2027, the company declared a $60,000 cash dividend. Determine the dividend paid to preferred stockholders and common stockholders under each of the following situations. So we'll go through a couple of these. The preferred stock is non-cumulative. The company has not missed any dividends in previous years. Okay, so two things here that we look at. One, they haven't missed any dividends, so there can't be anything in arrears because they've paid them each year. But it's also, preferred stock is non-cumulative, so even if they did miss a prior payment of dividends, they don't have to pay those dividends in arrears, so there can't be any dividends in arrears as well. So preferred stockholders are only paid this year's dividends. So $12,000 goes to preferred stockholders. Again, it's the number of shares times the percentage times the par value. So it's $6 per share, 2,000 shares, $12,000 go to preferred stockholders. The remaining, the $48,000, goes to common stockholders. The preferred stock is non-cumulative, and the company did not pay a dividend in each of the previous 2 years. Okay, so they did not pay the dividend, so we have to think about, is there any dividends in arrears? But since the preferred stock is non-cumulative, there won't be any dividends in arrears, so we don't have to worry about that. So again, solution's the same way. The past unpaid dividends do not have to be paid, so preferred stockholders get the $12,000, common stockholders get the remaining balance, the $48,000. The third example, the preferred stock is cumulative, and the company did not pay a dividend in each of the previous 2 years. So they did not pay a dividend, so we have to look at the preferred stock to see if it's cumulative, to see if there's dividends in arrears. In this case, it is. So we have to pay those previous 2 years first. So preferred stockholders in this case aren't going to get the $12,000. They're going to get $36,000. So it's the $12,000 from this year and $12,000 from each of the previous 2 years, $36,000 go to preferred stockholders. That means the common stockholder, what's left is only $24,000, so much less than what it was if the preferred stock was non-cumulative or if they had paid the dividends in previous years. Stock dividends. Some reasons that companies may want to issue stock dividends. So they're going to issue and distribute a pro rata, proportional to ownership of the company's own stock to stockholders, transfers an amount from retained earnings to paid in capital, does not decrease total stockholders' equity or total assets. Cash dividend does do that. It does not result in a distribution of assets. It often issued by companies that do not have cash to issue a cash dividend. Could be issued to increase the marketability of corporation stock. It could be issued to emphasize that a company has permanently reinvested in the business a portion of stockholders' equity. A small stock dividend, It's less than 20 to 25% of the corporation's outstanding stock is recorded at fair market value. A large stock dividend greater than 20 to 25% of outstanding stock is recorded at par or stated value. So the accounting of small stock dividends is based on the assumption that will have little effect on the market price of the outstanding shares. So such a small percentage of what's outstanding, it's not going to drastically change the market price. So we're going to account for it a little bit differently. So if Medlane Corporation declares a 10% stock dividend on its 50,000 shares of $10 par value common stock, the current fair market value of its stock is $15 per share. Record the entry on the declaration date. So the stock dividend is going to be debited. So that account is going to be debited. So it's similar to cash dividends being debited when we declare it. So 50,000 shares, 10% is the dividend. So 10% of those shares times $15 market value. So $75,000. Common stock dividends distributable is $50,000. And paid in capital in excess of par common stock, $25,000. Okay, we get the $50,000 that we credit common stock dividends distributable by the 50,000 shares times 10%. It's 5,000 shares times the $10 par value. So that's at the par value. The difference goes into paid in capital in excess of par, similar to if we were selling or issuing the stock. So in the paid in capital section on the balance sheet, we have our common stock that stays at our $500,000. Common stock dividends distributable is $50,000 and paid in capital in excess of par is $25,000. So $575,000 is our total paid in capital. So that's when we declare it. When we issue the dividends, we're going to debit the common stock dividends distributable and credit common stock. That's the 50,000, that's the 5,000 shares at our par value. We just show that now in common stock once it's distributed. And if we look at the effects on the stock dividends, before the dividend, we had $5,000 in common stock, no paid in capital in excess, $300,000 in retained earnings, total stockholders' equity $800,000, 50,000 shares outstanding, $10 par value. The change was we are going to credit common stock 50,000, credit paid in capital in excess of par of 25,000. We debited that stock dividend account, just like any other dividend account we talked about, the dividends and then the cash dividends. That gets closed into retained earnings, so it decreases retained earnings for that $75,000. So we're going to reduce our retained earnings. So we increase our paid in capital, reduce retained earnings, no change in total stockholders' equity. We have 5,000 additional shares outstanding. So after the dividend, we have 55,000 shares outstanding. Our total stockholders' equity remains at $800,000, but we have a swing between retained earnings and paid in capital of that $75,000 dividend that we paid, and we have no change in our par value. So review question. Which of the following statements about small stock dividends is true? A debit to stock dividends for the par value of the shares issued would be made. A small stock dividend decreases total stockholders' equity. Market value per share should be assigned to the dividend shares. A small stock dividend ordinarily will have an effect on par value per share of stock. We just went through that example, and the market value should be used as the true answer. The others are all false. In the stockholders' equity section, common stock dividends distributable is reported as, is it a deduction from total paid in capital and retained earnings, a current liability, deduction from retained earnings, in addition to capital. So the common stock dividends distributable account is going to be in addition to capital stock. Okay, so that's when we declare it, and before we pay it, we have a balance in that account, and it's in addition to capital stock. Stock splits. So it's the issuance of additional shares to stockholders according to their percentage ownership, reduction in the par or stated value per share, increase in the number of shares outstanding, reduces the market value of shares. No journal entry is recorded. So a stock split changes the par value per share, but that does not affect any balances in stockholders' equity. So here's an example of a 4-for-1 stock split for stockholders. Before the stock split, he owned 40 shares. 4-to-1 split, he now owns 160 shares, but still only a quarter of the company. So it's the same percentage ownership. You're just increasing the number of shares. The market price is going to be reduced by what the split is. So Medland Corporation, assuming it splits its 50,000 shares of common stock on a 2-for-1 basis. So here's what it is before, here's the change, and after. So common stock doesn't change. We're not changing any of that. Retained earnings doesn't change. Our stockholders' equity will not change. The only thing that changes is our outstanding shares. 2-to-1, we're going to issue the same number of shares, the 50,000, so we're going to have 100,000 shares outstanding. And our par value per share is going to be cut in half. So it's going to reduce by half. So our $500,000 common stock is $10 per share, 50,000 shares. Now our $500,000 is 100,000 shares at $5 per share, par value. And again, there's no entry needed. Just when we produce the financial statements showing the different shares outstanding and that type of thing will change. So here's the difference between stock dividends and stock splits. So total paid in capital will increase under a stock dividend. Total retained earnings decreases. Total par value of common stock will increase in a stock dividend. Be no change in those accounts in a stock split. The par value per share with a stock dividend, there's no change, but it's going to decrease in a stock split. Outstanding shares increase in both cases, and total stockholders' equity in both cases, no change is going to happen to the total stockholders' equity value. So Warren Buffett owns Berkshire Hathaway. He's retiring this year. He has 2 classes of shares. Until recently, the company had never split either class of stock. Class A stock has a market price of about $390,000 per share. Because the price per share is so high, stock does not trade as frequently as the stock of other companies. Buffett has always opposed these stock splits because he feels that lower stock price attracts short-term investors. He wants to be more of a buy and hold type of investor. While more than 6 million shares of IBM are exchanged on the average day, only 1,000 Class A shares of Berkshire are traded. Despite his aversion to splits, in order to accomplish a recent acquisition, they decided to split their Class B shares 50-to-1. So why does he usually oppose stock splits? He prefers to attract shareholders who will make a long-term commitment to his company as opposed to traders who will only hold their investment for a short period of time. He believes high stock price discourages short-term investment. Netflix, publicly traded company, just recently here in November of 2025 did a 10-to-1 stock split. So their shares were trading at over $1,000 per share, just like something like $1,100 or something. They split and immediately their share price went to $110 and then started trading at $110. 10 times as many shares are out in the marketplace now. So their philosophy was they wanted to attract more investors. So they split and lowered the market price by 10, a factor of 10, and they wanted to attract more investors and get more people being able to afford shares of their stock. Sing CD Company has had 5 years of record earnings. Due to this success, the market price of its 500,000 shares, $2 par value, common stock has tripled from $15 per share to $45. During this period, paid-in capital remained the same at $2 million. Retained earnings increased from $1.5 million to $10 million. The president is considering either a 10% stock dividend or a 2-for-1 stock split. She asks you to show the before and after effects of each option on retained earnings, total stockholders' equity, shares outstanding, and par value per share. So what does that look like? Here's the comparison. So here's our original balances, $2 million paid in capital, $10 million in retained earnings, $12 million in total stockholders' equity, $500,000 shares outstanding, $2 par value. If we do a dividend, remember again, we're going to take value out of retained earnings, so that's going to decrease, and put it in paid in capital, that will increase. And it's at 10% split is what they were thinking about. So the dividend would be $2,250,000, so the $500,000 times 10% at $45 market price. Since it's a small dividend, it goes to market price. And we take that $2,250,000 out of retained earnings into and paid in capital. Our total stockholders equity does not change. Our shares outstanding increase by 50,000 shares, 10%, and our par value doesn't change. If we did a split, our paid in capital will not change, our retained earnings will not change, total stockholders equity does not change, but our shares outstanding, since we're doing a 2-for-1, it's going to go from 500,000 to 1 million, and our par value is going to be cut in half from $2 to $1. So depending on how they want to show this will determine how they want to approach this and what their decision will be. So do they want to maintain the paid-in capital at 2 million, or do they want to increase it? And do they want to double the number of shares outstanding, or just increase it by the 10%? So those are all factors that they will then need to determine to decide what to do. So discuss how stockholders' equity is reported and analyzed. Retained earnings is net income that a company retains in the business. Part of the stockholders' claim on the total assets of the corporation. It does not, however, represent a claim on any specific asset. A $100,000 balance in retained earnings does not mean that there should be $100,000 cash. So here's some examples of some companies, what their retained earnings are, and what their cash balance are. So Meta, 77 billion in retained earnings, 17 billion in cash. Alphabet, 152 billion in retained earnings, 18 billion in cash. Nike, smaller retained earnings, they have more cash. Starbucks actually has a net deficit in their retained earnings of $7.8 billion. But they have $4 billion in cash. And Amazon, $93 billion in retained earnings, $42 billion in cash. So the retained earnings does not equal cash. When a company has net income, it closes retained earnings. It closes income to retained earnings. When a company has a net loss, it also closes this amount to retained earnings. So remember, close revenue to income summary, expenses to income summary. If you have net income, there will be a credit balance in that account. If you have a net loss, there will be a debit balance in that income summary account. So assume Rendell Corporation has a net loss of $400,000 in 2027. When we close income summary, it's going to have a debit balance of $400,000 because it's a net loss. We're going to credit that income summary and debit retained earnings. They do not debit losses to paid-in capital accounts. It goes to retained earnings. And if cumulative losses exceed cumulative income over a company's life, a debit balance and retained earnings results. That's identified as a deficit. So if you look at Groupon here, we've got their paid-in capital. So common stock, paid-in capital in excess of par, total paid-in capital. Accumulated deficit, instead of retained earnings, we call it accumulated deficit on the balance sheet. So that's a negative number, and our total paid-in capital and retained earnings is smaller than our total paid-in capital. And then they also have some treasury stock, which reduces stockholders' equity as well. Sometimes retained earnings has restrictions on it. So that makes a portion of the balance currently unavailable for dividends. Can be different reasons for restrictions. It could be legal restrictions, could be contractual restrictions, or voluntary restrictions. So here's an example of a note in the financial statements that says certain of the company's debt agreements require compliance with debt covenants. The company had unrestricted retained earnings of $223.8 million after meeting those requirements. So without seeing the rest of the balance sheet, we can only make assumptions, and what I would assume is that the retained earnings is much larger than this number that they give here, but they had to restrict some of that because of their debt agreements, their debt covenants. So they only have $223 million to pay out in dividends, and so that's what that note means. Stockholders' equity section of the balance sheet, companies report paid-in capital, retained earnings, accumulated with other comprehensive income, treasury stock. Within paid-in capital, two classifications: capital stock, which is preferred and common stock. We've seen examples of that in this lecture. Companies show preferred stock before common stock because of its preferential rate. They report information about the par value, shares authorized, shares issued, shares outstanding. And then within the paid-in capital, they show the additional paid-in capital, which is the excess of amounts paid in over par or stated value. So here's an example. We've got preferred stock and common stock. We've got the information about each of those, the stated value, the par value, and then preferred stock, it says if it's cumulative, the number of shares authorized, number of shares issued and outstanding. Same with the common stock, number authorized, number of issued, number of outstanding. Total capital stock, it's a total of those two. Then the additional paid-in capital, both preferred stock and capital, so a total additional paid-in capital, and that gets added to get the total paid-in capital. Then we have retained earnings, so total paid-in capital and retained earnings, and then they have 10,000 shares of treasury stock, so they show that at their cost to get total stockholders' equity. So that's an example of the stockholders' equity. It's getting a lot more detail and more categories than what we initially saw with just common stock and retained earnings. Jennifer Corporation has issued 300,000 shares, $3 par value common stock. Authorized to issue 600,000 shares. Paid-in capital in excess of par value in common stock is $380,000. It has reacquired 15,000 shares at a cost of $50,000. currently holding those shares. Corporation also has 4,000 shares issued and outstanding of 8% $100 par value preferred stock. It is authorized to issue 10,000 shares. Paid in capital in excess of par value on the preferred stock is $97,000. Retained earnings is $610,000. Prepare the stockholders' equity section of the balance sheet. So a lot going on here. We've got to break it down. So we've got common stock and preferred stock. We've got par values of both of those. We know the number of shares issued and outstanding. We know how much is authorized. We have some treasury stock, and we have retained earnings. So how we show that on the balance sheet, first we're going to do the capital stock and preferred stock first, then common stock. And we're going to list all that information that was given in the problem, the par value, the number of shares issued, number of shares authorized, number of shares outstanding. We have paid in capital in excess comes next. So we list preferred stock and common stock and get a subtotal. Then we get total paid in capital. We show our retained earnings. We get a total there, total paid in capital and retained earnings. And then we subtract our treasury stock at cost, $50,000 in this case, to get our total stockholders' equity. Some analysis on stockholders' equity. We can look at the payout ratio. So Nike's dividends were recently 1,491 million. Net income was 2,539 million. So the payout ratio is the cash dividends paid on common stock divided by net income. So using those figures, we see a payout ratio of 58.7%. It's just a percentage of earnings that a company distributes in the form of cash dividends to common stockholders. So if you want to invest in a company that pays, strong and high dividends, you look for a company with a high payout ratio. Here's some examples. Microsoft was 24.5%, Kellogg 43%, Meta doesn't pay a dividend to common stockholders, and Walmart 49%. It's almost 50% of their earnings of Walmart gets paid to common stockholders. So if you're looking for companies that pay large dividends, it would be Nike and Walmart in these examples. If you wanted lower ones, you would look at Meta and Microsoft. Return on common stockholders' equity. So Nike's beginning of the year and end of the year common stockholders' equity, $9 billion and $8 billion. Its net income was $2.5 billion. No preferred stock was outstanding. So the return on common stockholders' equity is net income minus preferred dividends divided by average common stockholders' equity. So in this case, they had no preferred dividends, so it's just net income divided by average common stockholders' equity, and we get 29.7%. So this ratio shows how many dollars in net income the company earned for each dollar invested by the common stockholders. So they're making almost 30% return on each dollar common stockholder investment. So we'll do a couple of these calculations. Here's some information for Sienna Corporation. They purchased 2,000 shares of treasury stock. Here's some other information for 2027 and 2026. Compute the return on common stockholders' equity for each year and discuss its change from 26 to 27. So note that the beginning of the year common stockholders' equity is 400,000, which does not match the end of the year of the previous year. That's because they've made the treasury stock purchase on January 1st, so they readjust the beginning to account for that. And here's the calculations. So for 2027, income of 110,000 minus 10,000 preferred dividends, $400,000 average common stockholders' equity, 25% return in 2027. 2026, income and dividends were paid the same, but our common stockholders' equity was higher at $500,000 average, so we only have a 20% return. So between 26 and 27, return on common stockholders' equity improved. It went from 20% to 25%. While this would appear to be good news for the company's common stockholders, this increase should be carefully evaluated. It is important to note that net income did not change during this period, so $110,000 in both cases. The increase was totally due to the purchase of the treasury shares, which reduced the denominator, which increased the ratio. Companies repurchased its own shares, became more reliant on its debt, and thus increased risk. So even though on the surface it looks good, you need to understand what's driving it, and it's not necessarily a good thing for the stockholders. That's it for Chapter 11. As usual, reach out if you have questions, and good luck on the homework.